We are taking stock of earnings from Mastek, and well, the earnings look mixed. But to take us through the quarter and what we can expect going forward, I am in conversation with John Owen, the CEO of Mastek. John, good afternoon, and thanks for taking the time out. Let's start with your assessment of the quarter, of the growth, which at least sequentially has been flat. We have seen an improvement in your operating margins. What factors do you attribute to this quarter's earnings?
First of all, I think it is a seasonally weaker quarter, so I think that's reflected across the industry. So I think if we are, let's look at our exposure to the UK, 76% of our business comes from the UK. So I am pleased that we stabilised in the UK from Q2, and I expect us to grow into Q4. And as you say, because we get so much from the UK with a favourable exchange rate, it allows us to maybe offset some of the performance we've seen in the US, which has been a little bit weaker. But again, I expect that market to recover in Q4. So I think your introduction was probably fair. It is a mixed bag. But I think if you look at the underlying fundamentals of our ability to manage external factors, the ability to manage sort of seasonal shutdowns, particularly in the UK with our biggest customer, when you move that forward, the fundamentals for Q4 look encouraging. So I think we're turning a corner. So I think your reflection is fair, it's mixed. But if I look at the underlying fundamentals, I'm quite encouraged about where we're going, and we should get back to our trajectory of growth that we've enjoyed in the last 3 years.
Right, John, I understand that furloughs may have also played a part as far as this quarterly earnings go, but looking forward, if you could give us an idea about what the deal signing has been, how things have panned out for the quarter, as well as the pipeline, so as to get a better outlook and better sense for Mastek.
Yeah, and I think, again, if you look at it through the UK lens, we went through a general election. The government essentially shut down for about 6 weeks. So there are projects that have moved to the right from a bookings perspective. But I'm pleased to report lots of those are starting to come through as they go through the approval process. So I think Q4, our bookings position should be strong. And it's probably, hopefully, one of the best quarters that we've had in bookings. That, in fairness, just corrects for some of the softness that we've had in prior quarters. From a revenue perspective, it should flow into revenue, and if you then look at that coming through into earnings, I expect us to be holding our operating EBIT. From a US perspective, again, the organizational change we've made is flowing through into more activity. We're putting more salespeople and investment into the market, and I start to see, looking at their pipeline, I am confident that the US will recover and then kick on through fiscal 21 to get back to some sort of growth. But I think the US it's a difficult market. It's very retail orientated, and I think we all look at the retail segment, and it is globally quite a depressed segment. It's got its challenges. So I think overall, at a group level, I'm encouraged where we're going. I think we've stabilised. I look at the forward-looking indicators of pipeline, order book, converting that to revenue. I'm encouraged where we'll be, and I think now we've got a better cost structure moving forward. I think we'll have more flex in the organisation, which should allow us to yield better earnings in the long term.
Right, John, just a final word then on, well, the macros of the US and the UK markets. We've been talking to a lot of your peers, and there is a suggestion that at this point, clients are in general not very confident about spending and, well, discretionary spending. And also when it does come to allocation in terms of technologies, a lot of them are currently still choosing between allocating funds towards your traditional legacy businesses, that is your run the business, as against your newer digital initiatives. What is your reading, and what kind of conversations are you having with your clients here?
So I think you're right from a macro. I think a lot of people will look at the US and seeing there's an election, and the jury's out about what does that mean for spending. So in that market, I do see discretionary spending probably being held off. In the UK, if you're in the digital world, I think the UK, the UK, I think, now has some clarity politically as the UK exits Brexit. And I think political stability is going to give a lot of confidence back to discretionary spend. So a lot of the UK market didn't spend in 2019 calendar. I expect that to come through into 2020. But again, I think as people go and they become digital companies, the reality is they can't afford not to spend in digital. It is about driving market leadership. It's about informing your customers, your citizens, whatever it is. I do see, I'm more confident about fiscal 21 than lots of my peers. And a lot of it is through the lens I look at, through a very strong UK government business, a UK general economy that's probably going to feel a little, it's going to get some tailwinds from not spending last year. But I think the US is probably, the jury's out on the discretionary spend. And, in fairness, to be balanced, our exposure to the US is not that great. It's 25% of our business. We'd like it to be a bit more, and that's what we'll be working towards. But I think we'll look at the UK, and we feel optimistic going into the year.
Okay, John, we'll leave it at that. Thank you so much for taking us through these earnings. Thank you.